Look, I need you to pay very close attention to what I'm about to tell you, because what's happening in the silver market right now is something most people won't see coming until it's too late. And by then, the opportunity will be gone. Right now, as I'm recording this, silver is trading in a range that's creating what I can only describe as a coiled spring. The technical setup, the fundamental drivers, and the institutional positioning are all converging at the same time. And when I say converging, I mean we're looking at a situation where multiple forces are pushing in the same direction, creating pressure that has to release somehow. Let me paint you a picture of what's actually happening behind the scenes. Because the mainstream financial media isn't telling you this story. They're focused on stocks, on Bitcoin, on whatever the flavor of the week is. But while everyone's looking the other way, something extraordinary is building in the silver market. Start with the supply side. Global silver mine production peaked back in 2016 at about 900 million ounces. Since then, we've seen production decline to around 830 million ounces. That's a 70 million ounce deficit just from the mining side. But here's where it gets interesting. The easy silver has already been mined. The high-grade deposits that made mining profitable at lower prices, those are largely depleted. What's left requires more energy, more processing, more capital investment to extract. And energy costs aren't going down. Diesel fuel, electricity, the cost of moving massive amounts of earth to extract silver, all of that has increased dramatically. I was looking at data from primary silver mines in Mexico, which produces about 23% of the world's silver. Their all-in sustaining costs have jumped from around $12 per ounce 5 years ago to over $18 per ounce today. Some operations are running at $20 or higher. Now, silver is currently trading around $31 per ounce. Sounds like a decent margin, right? But here's what most people don't understand. About 70% of silver production doesn't come from primary silver mines. It comes as a byproduct of mining other metals, mainly copper, lead, and zinc. When copper prices drop, those mines slow down or shut down, and silver production drops with it. The miners aren't making decisions based on silver prices. They're making decisions based on the primary metal they're after. We saw this play out in 2023 when several major copper-zinc operations in Peru reduced output due to lower base metal prices. Silver production from those operations dropped by 15 million ounces. Nobody was talking about it. No headlines. But that silver just disappeared from the supply chain. Now let's talk about demand, because this is where the story gets really compelling. Industrial demand for silver hit a record 539 million ounces last year. Solar panels alone consumed 161 million ounces. And solar installation rates are accelerating. China is building solar capacity at a pace that's hard to comprehend. They installed 216 gigawatts of solar in 2023. Each gigawatt requires roughly 750,000 ounces of silver. Do the math. That's 162 million ounces just for China's solar build-out. But it's not just solar. Electric vehicles use about twice as much silver as traditional cars. Every EV contains roughly 25 to 50 grams of silver in various components, from the battery management system to the charging infrastructure. Global EV sales hit 14 million units last year. That's another 10 to 15 million ounces of silver demand that didn't exist a decade ago. 5G infrastructure. That's another massive silver consumer. Every 5G base station uses about 3 to 5 times more silver than a 4G station. There are over 3 million 5G base stations operating globally now, with projections to hit 10 million by 2027. Each one of those stations requires silver for its conductivity properties. There's no substitute that works as well at the same cost point. Medical applications, water purification, electronics manufacturing, the list goes on. Industrial demand isn't discretionary. These aren't jewelry buyers who can choose to wait if prices go up. These are manufacturers who need silver to produce their products. They have contracts to fulfill, production schedules to meet. When they need silver, they buy it, regardless of price. And here's the kicker. Investment demand is starting to wake up. Silver ETF holdings dropped significantly in 2022 and 2023 as investors rotated into other assets. But in the last 6 months, we've seen that trend reverse. The iShares Silver Trust added 12 million ounces in the past 90 days alone. That's institutional money coming back into the market. But the real story, the one that should have your attention, is what's happening in the physical market. Premiums on physical silver coins and bars have been elevated for months. The U.S. Mint sold 4.2 million Silver Eagles in the first quarter of this year. That's a 28% increase over the same period last year, and they've had to ration sales to dealers multiple times because they can't keep up with demand. I talked to a dealer in Texas last week who told me his wait time for generic silver rounds is now 3 weeks. 3 weeks. That's not normal. In a healthy market with adequate supply, you order silver and it ships in a few days. When you're waiting weeks, that tells you something about the tightness in the physical market. The COMEX silver inventories tell a similar story. Registered silver, that's the silver available for delivery against futures contracts, has dropped from 140 million ounces 2 years ago to under 50 million ounces today. That's a 64% decline. Meanwhile, open interest in silver futures has remained elevated. More contracts, less silver available to deliver. That's a squeeze waiting to happen. Now, I want to take you back to 2011 for a moment, because there are some eerie parallels to what we're seeing today. In early 2011, silver was trading around $27 per ounce. The fundamentals looked strong. Industrial demand was growing. Investment demand was accelerating. And then something happened that caught most people off guard. In January 2011, silver started climbing. By late April, it had rocketed to $49 per ounce. That's an 81% gain in less than 4 months. What drove it? A combination of factors. Physical demand overwhelmed available supply. Investors piled in, fearing they'd miss the move. Short sellers got caught and had to cover their positions, adding fuel to the fire. But here's what's different about today. In 2011, industrial demand for silver was about 487 million ounces. Today, it's 539 million ounces and growing. In 2011, solar panel production consumed about 30 million ounces of silver. Today, it's over 160 million ounces. The structural demand is significantly higher now, and the supply situation is tighter. Back in 2011, mine production was still increasing. Today, it's declining. The deficit between supply and demand was about 50 million ounces in 2011. Today, depending on whose numbers you trust, we're looking at a deficit of 150 to 200 million ounces. That deficit has to be filled from somewhere, and it's being filled from above-ground inventories. But those inventories aren't infinite. At some point, the drawdown becomes unsustainable, and prices have to rise to either stimulate more supply or destroy demand. That's basic economics. Now, if you're sitting on retirement savings, if you've got $100,000 or more in traditional accounts, this is something you need to be thinking about. I put together a comprehensive guide on how gold IRAs work, how you can get physical precious metals into your retirement account without triggering tax penalties. It's in the description below. Covers the whole process, the rules, what you need to know. Worth checking out if wealth preservation is part of your strategy. Anyway, back to what's happening right now in the market. Because the technical picture is setting up in a way that's really interesting. Silver broke above its 200-day moving average 6 weeks ago and has held above it. That's significant from a technical standpoint. It suggests the trend has shifted from bearish to bullish. The relative strength index is sitting at 58, which means there's room to run before the market becomes overbought. We're not in euphoria territory yet. Retail investors aren't piling in. Your neighbor isn't asking you about silver. That's actually a good sign if you're looking to position yourself before the crowd arrives. Volume patterns are showing accumulation. Large block trades, the kind that institutions make, have been increasing. Somebody with deep pockets is building a position. They're not doing it all at once because that would move the market. They're doing it gradually, methodically, absorbing available supply without pushing prices up too quickly. I've been watching the gold-to-silver ratio closely, and this is telling us something important. The ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, that ratio has averaged around 60 to 1. During times of economic stress, it can spike to 80 or even 100 to 1 as investors flee to gold safety. Right now, we're sitting at about 88 to 1. That's elevated. It suggests silver is undervalued relative to gold. And historically, when this ratio gets stretched, it tends to snap back violently. In 2020, the ratio hit 125 to 1 in March, then collapsed to 70 to 1 by August. Silver went from $12 to $29 in that time frame, while gold gained about 25%. Silver outperformed by a massive margin. Why does this happen? Because silver has this dual nature. It's both an industrial metal and a monetary metal. When economic conditions improve, industrial demand drives prices. When economic conditions deteriorate, investment demand drives prices. Silver wins in both scenarios. It just takes different paths to get there. And right now, we're in this interesting environment where both drivers are present. Industrial demand is strong and growing. And investment demand is starting to percolate as people wake up to the inflation story, the currency debasement story, the geopolitical instability story. Let me tell you about what's happening with central banks, because this is a piece of the puzzle most people are missing. Everyone knows central banks have been buying gold at record rates. China, Russia, India, Turkey, they've been accumulating thousands of tons. But what people don't realize is that silver often follows gold's moves, just with more volatility. When central banks buy gold, they're making a statement about their confidence in fiat currencies. They're diversifying away from dollars, euros, yen. And when that happens, it creates a psychological shift in how people think about precious metals. If the world's central banks don't trust paper currencies, why should you? That mindset shift is already happening. You can see it in the data. Retail investment in precious metals has been climbing steadily. Coin sales, bar sales, ETF inflows, it's all pointing in the same direction. People are looking for alternatives to traditional financial assets. And here's something that should concern you. The derivatives market for silver is enormous. The notional value of silver derivatives dwarfs the actual physical market by a factor of 100 or more. That means there are massive paper claims on silver that far exceed the amount of physical silver available. As long as everyone's content to trade paper, that system works. But the moment people start demanding physical delivery, the whole structure becomes unstable. We saw a glimpse of this in 2021 with the Reddit silver squeeze. Retail investors tried to corner the physical market, and while they didn't succeed in breaking the COMEX, they did expose how tight the physical market really is. Premiums on physical silver spiked to $10 over spot. Dealers ran out of inventory. The U.S. Mint couldn't keep up with demand, and that was just retail investors with relatively limited capital. Imagine what happens if institutional money decides it wants physical silver instead of paper claims. There's a scenario playing out in my mind, and I want to walk you through it because I think it's more likely than most people realize. Let's say silver breaks above $35 per ounce. That's only about 13% from current levels. Not a huge move in the context of silver's volatility, but $35 is a significant technical level. It's where silver topped out in 2021 before pulling back. It's a level that's been tested multiple times over the past decade. If silver breaks through $35 with conviction, with volume, that's going to trigger algorithmic buying from trend-following funds. These are computer programs that buy breakouts automatically. That buying pressure pushes silver to $40. Now you've got a 29% gain from current levels, and suddenly silver is making headlines. CNBC is talking about it. Financial websites are writing articles. Your neighbor is asking you about it. That's when retail FOMO kicks in. Retail investors start buying silver eagles, buying SLV shares, buying silver mining stocks. That creates another wave of demand. Silver pushes to $45, then $50. At $50, you're up 61% from today's price, and now the short sellers are in trouble. There are hedge funds and banks that have short positions in silver, betting that prices will go down. When prices go up instead, they have to buy silver to cover their shorts and limit their losses. That's called a short squeeze, and it adds explosive fuel to an already rising market. We saw this exact pattern play out in 2011. We saw it in 2020. And the setup today looks remarkably similar, except the fundamental backdrop is even stronger. The supply deficit is larger, industrial demand is higher, and the macroeconomic environment is more conducive to precious metals appreciation. Think about what's happening in the broader economy. We've got inflation that's proving stickier than central banks expected. The Federal Reserve thought they could raise rates and quickly bring inflation back to 2%. Instead, we're stuck at 3% to 4%, and core inflation isn't budging. Meanwhile, government debt levels are at historic highs. The U.S. national debt just crossed $36 trillion. That's trillion with a T. The interest payments on that debt are now over $1 trillion per year. That's more than we spend on defense. At some point, the math stops working, and the only way out is to inflate the debt away. What does that mean? It means the purchasing power of your dollars is going to decline. The money you've saved, the money in your bank account, the money in your 401k, if it's in cash or bonds, that money is losing value in real terms. You might see the same number on your statement, but what that number can buy is shrinking. Silver, like gold, is a hedge against that currency debasement. It's a store of value that's been recognized for thousands of years. You can't print silver. You can't create it out of thin air with a keystroke. It has to be mined, refined, fabricated. That scarcity gives it value. And unlike gold, silver is affordable for average investors. You can buy a 1-ounce silver eagle for about $35. Try buying an ounce of gold at $2,750. Silver gives you exposure to the precious metals thesis without requiring massive capital. But here's what you need to understand. The window for accumulating silver at these prices is closing. Not tomorrow, not next week, but it's closing. Once the momentum builds, once the technical breakout happens, once the mainstream catches on, prices are going to gap higher faster than most people can react. I've seen this movie before. In 2010, I was telling people to buy silver at $18. Some listened, most didn't. By April 2011, those who listened had nearly tripled their money. The ones who waited, who wanted to see more proof, who needed more confirmation, they ended up buying at $40 or $45 right before the correction. In 2019, I was talking about silver at $14. People thought I was crazy. Silver's been dead for years, they said. It's never going back up. By August 2020, silver hit $29. The people who bought at $14 doubled their money. The ones who waited missed the move. I'm not saying silver is going to double or triple from here. I don't have a crystal ball. But I am saying the setup is there. The fundamentals support significantly higher prices. The technicals are turning bullish. The sentiment is still skeptical, which means we're early in the cycle. And here's something else to consider. Silver mining stocks offer leveraged exposure to silver prices. When silver goes up 50%, silver mining stocks can go up 100% or 150% because their profit margins expand dramatically. A company mining silver at $18 per ounce and selling it at $31 is making $13 per ounce. If silver goes to $45, they're making $27 per ounce. Their profits more than double. I'm looking at companies like First Majestic Silver, Hecla Mining, Pan American Silver. These are established producers with operating mines, positive cash flow, and strong balance sheets. They're not speculative exploration plays. They're real businesses that generate real profits from silver production. But even these stocks are trading at valuations that don't reflect what's coming. First Majestic is trading at about 8 times forward earnings. That's cheap by any measure. If silver breaks out and their earnings double, the stock could easily trade at 12 or 15 times earnings. That's a 100% to 200% gain just from multiple expansion, not even counting the earnings growth. Now, I want to address something that skeptics always bring up. Silver's been a terrible investment for the past decade, they say. It peaked in 2011 and went nowhere. And they're right. If you bought at the top in 2011 and held, you've been underwater for years. But that's true of any asset if you buy at the peak of a bubble. People who bought tech stocks in 2000 waited 15 years to break even. People who bought real estate in 2006 waited a decade. Timing matters. And right now, the timing for silver looks better than it has in years. The other thing skeptics say is, industrial demand can be destroyed if prices go too high. And again, there's some truth to that. If silver went to $100 per ounce, some industrial applications would find substitutes. But we're not talking about $100 silver. We're talking about $40, $50, maybe $60. At those levels, silver is still cost-effective for most industrial uses. A solar panel manufacturer isn't going to stop making panels because silver goes from $31 to $45. The silver cost in a solar panel is a tiny fraction of the total cost. Same with electronics. Same with EVs. The silver content is small enough that price increases don't significantly impact the final product cost. And here's the thing about industrial demand. It's sticky. Once a technology is designed around silver's properties, it's expensive and time-consuming to redesign it around a different material. Engineers don't just swap out silver for copper or aluminum on a whim. They'd have to retest, recertify, retool manufacturing. That takes years and millions of dollars. So industrial demand is going to remain strong even as prices rise. And investment demand is going to accelerate as prices rise, because that's how markets work. People buy what's going up. They avoid what's going down. It's momentum. It's psychology. It's human nature. I'm watching the options market closely, and there's been a noticeable increase in call buying on silver ETFs. Call options give you the right to buy silver at a specific price. When traders buy calls, they're betting on higher prices. The volume of call buying has increased 40% in the past month. That's smart money positioning for a move higher. The Commitment of Traders report, which shows positioning by different types of market participants, is also revealing. Commercial hedgers, who are typically the smart money, have reduced their short positions significantly. They're less bearish on silver than they've been in years. Meanwhile, managed money, the hedge funds and speculators, are starting to build long positions. This is the kind of positioning you want to see before a major move. When the commercials are less short and the speculators are getting long, It means the market structure is supportive of higher prices. Let me tell you about a conversation I had with a fund manager last month. This is someone who manages over $2 billion in assets. He told me he's been quietly accumulating silver exposure for his clients. Not a huge position, maybe 3% to 5% of portfolios, but enough to make a difference if silver takes off. I asked him why now, after years of silver underperformance. He said, "The risk-reward is too compelling to ignore. If I'm wrong and silver goes to $25, I lose 20%. If I'm right and silver goes to $50, I make 60%. That's a 3-to-1 payoff. I'll take that bet all day." That's how professional investors think. They're not looking for certainty. They're looking for asymmetric risk-reward. They want situations where the potential upside far exceeds the potential downside. Silver offers that right now. And it's not just fund managers. Family offices, the entities that manage wealth for ultra-high net worth individuals, are increasing their precious metals allocations. I've seen reports of family offices moving from 2% to 3% gold and silver up to 8% to 10%. That's a significant shift. These are sophisticated investors with access to the best research, the best analysts, the best information. They're not making these moves on a whim. They're seeing what I'm seeing. They're connecting the dots, and they're positioning accordingly. The geopolitical situation is another factor that's supporting precious metals. We've got ongoing tensions between the US and China. We've got the BRICS nations actively working to reduce their dependence on the dollar. We've got conflicts in the Middle East, in Eastern Europe, in other regions that create uncertainty. When uncertainty rises, investors seek safe havens. Gold is the traditional safe haven, but silver benefits from that same flight to safety. And because silver is more affordable, it's accessible to a broader range of investors. I'm also watching what's happening with the dollar. The US dollar index has been strong for the past couple of years, which has been a headwind for precious metals. But there are signs that dollar strength is peaking. The Fed is likely done raising rates. Other central banks are catching up. The interest rate differential that supported the dollar is narrowing. If the dollar weakens, that's rocket fuel for silver and gold. Precious metals are priced in dollars, so when the dollar falls, it takes fewer euros or yen or yuan to buy an ounce of silver. That increases demand from international buyers. We saw this dynamic play out in 2020. The dollar weakened significantly in the second half of that year, and silver went from $18 to $29. The correlation is strong and consistent. Weaker dollar equals higher precious metals prices. Now, I want to be clear about something. I'm not telling you to bet the farm on silver. I'm not suggesting you liquidate everything and go all in. That would be reckless. What I am suggesting is that silver deserves a place in a diversified portfolio, especially given the current setup. If you've got $100,000 in investable assets, putting $5,000 to $10,000 into silver isn't going to make or break you. But if silver does what I think it's capable of doing, that $5,000 could turn into $10,000 or $15,000. That's a meaningful return that can offset losses in other parts of your portfolio if things go south. And here's the thing about silver. It's not correlated with stocks or bonds. When the stock market crashes, silver doesn't necessarily crash with it. In fact, it often goes up as investors seek alternatives. That's the beauty of diversification. You want assets that don't all move in the same direction at the same time. The clock is ticking because the longer you wait, the higher the entry price becomes. Silver at $31 is a better deal than silver at $35 or $40. And once the momentum builds, once the breakout happens, you're not going to get a chance to buy at these levels again. I've been in this market long enough to recognize when the pieces are falling into place. The supply deficit, the industrial demand growth, the investment demand awakening, the technical setup, the macroeconomic backdrop, it's all pointing in the same direction. This doesn't happen often. When it does, you have to pay attention. So here's what I want you to do. Take a serious look at your portfolio. Ask yourself if you're adequately positioned for what's coming. If inflation stays elevated, if the dollar weakens, if geopolitical tensions escalate, if any of these scenarios play out, are you protected? Do you have assets that will hold their value or appreciate? Silver gives you that protection. It's been money for 5,000 years. It's not going away. It's not going to zero. It has intrinsic value based on its industrial uses and its monetary properties. That's a foundation you can build on. The stackers, the people who've been accumulating physical silver for years, they understand this. They're not worried about day-to-day price fluctuations. They're thinking long-term. They're building a position that will protect their wealth regardless of what happens in the broader economy. And right now, they're on the clock. Because the window for accumulating at these prices is closing. The smart money is already positioning. The technical breakout is setting up. The fundamentals are stronger than they've been in years. Everything is aligning. The question is, are you going to act? Or are you going to watch from the sidelines and wish you had? Because I can tell you from experience, regret is a lot more painful than taking action and being wrong. At least when you act, you're in the game. You have a chance. When you sit on the sidelines, you've already lost. Silver stackers are on the clock. The countdown is on, and the opportunity is right in front of you. What you do with it is up to you.